The IRS just released their latest data book, which summarizes all of their activities for the previous year, including their audit activities, which is extremely valuable. By knowing who the IRS is auditing and why they are auditing those taxpayers, we can better protect ourselves from IRS audits and avoid all the stress that comes with it. Plus, depending on your income and circumstances, you may be subject to a higher risk of being audited already, which is extremely important to know. So in this episode, I am going to break down your chances of being audited, and more importantly, how to avoid one according to this new report and my experience as a licensed CPA at mycpacoach.com. So let's jump right into it. Okay, so let's bring you up to speed on all the recent noise about IRS audits over the past few years here, just so that you know what's going on. From 2010 to 2021, the IRS has been facing a big problem, a decreasing budget and staff in comparison to the number of tax returns being filed. This actually resulted in a significant decrease in audit rates. However, in 2022, Congress passed the IRS Inflation Reduction Act, which granted $80 billion in additional funding to the IRS, which was intended to increase audit rates and IRS collections. We saw many headlines of how the IRS could be hiring thousands of new agents with these funds and even gearing those agents with ammunition. But the truth is that this budget has been getting cut by Congress each year, losing $20 billion in 2024 and another $20 billion in 2025 through various acts. So the first question we need to answer is if audit rates have been increasing or not based on the most recent data. Let's take a look. According to the latest data book, the IRS closed a little over 505,000 audits in 2024, which is down from nearly 583,000 audits in 2023. Which means the number of audits are still decreasing based on the most recent data here. But even with that, certain groups of people are still subject to increased audit risk based on their income, the type of return they file, and the information that they report on their tax return. So let's take a closer look at those 500,000 audits and split them into various categories to explore your odds of an IRS audit, and then we will talk about how you can actually avoid an audit in the first place. So of the 505,000 closed audits, 444,000 were related to individual tax returns. And nearly half of those audits were on taxpayers reporting less than $50,000 in income, including those reporting negative income on their tax returns. Individuals reporting less than $25,000 in income were 3 to 4 times more likely to be audited than individuals reporting between $50,000 to $75,000 in income. So it begs the question as to why the IRS is auditing this group of people more than others. Well, the first big thing to understand is that the IRS is concerned about taxpayers underreporting their income, or in some cases not reporting it at all, causing them to audit this group more frequently. Many high-income earners in reality are actually able to report very little income on their tax returns, so much so that they show little to no taxable income. Well, those returns may fall in this under $25,000 category here as well, and be the reason why these returns are being audited at a much higher rate. Also, it's worth noting that the IRS also frequently audits returns that claim the earned income tax credit, which is a refundable tax credit that they see a lot of fraud and improper claims with. Over a third of closed audits were related to those tax returns alone. But on a percentage basis, your odds of actually being audited when reporting less than $100,000 per year in income is generally less than 0.5% based on closed audits related to the 2022 tax year. And your odds start to increase as your income rises beyond a certain level as well. For example, once your income exceeds $500,000, you are more likely to be audited. For example, just 0.1% of tax returns with $100K to $500K in income were audited, in comparison to 0.6% of returns showing $500K to $1 million in income. So 6 times more returns were audited in this group than the last group. And that trend continues as 1.1% of returns reporting between $1 to $5 million of income being audited, doubling from the prior group. And then it jumps again to 3.1% of returns that show $5 to $10 million of income, and 4% on returns that report more than $10 million. So from an income perspective, it is clear that your odds of being audited significantly increases when either A, you report little to no income at all, or B, you report more than $500,000 in income. But that's not it. The type of tax return you file and the schedules associated with it can also significantly increase your odds of being audited. For example, gig workers and self-employed individuals who use Schedule C on their tax returns are notoriously known for having higher rates of audits. For example, the 2018 IRS data book shows that the audit rate for Schedule Cs were as high as 2.4%. while non-Schedule C returns were audited as low as 0.2%. And by the way, I'm looking at 2018 for this because the IRS chose to stop highlighting their audit rates for Schedule Cs after this period of time. But it is still believed that IRS audits for these types of taxpayers are still close to 2% each year. That's nearly a 1 in 5,000 chance of being audited. So if you operate as a sole proprietor, single member LLC, or just an independent contractor, you may be subject to a higher audit rate if you continue to be taxed as a Schedule C taxpayer, which can be changed, by the way. Also, real estate investors using Schedule C also saw a higher audit rate as well, of about 0.8% when compared to non-Schedule E tax returns. Now, in comparison to all of this, businesses and investors that file as a partnership, S corporation, or C corporation are hardly audited at all. Only 1,500 S corp returns were selected to be audited so far, anyway, in 2022, out of 5.2 million S corp returns. That's an audit rate of about 0.03%. Or in other words, your business would have a 1 in 3,000 chance of being selected for audit as an S corporation. It's a similar story for partnerships. Out of the 4.5 million partnership returns that were filed in 2022, only 940 of them has been selected for an audit, bringing the audit rate to 0.02%. That's nearly a 1 in 5,000 chance of being audited. Even big C corporations are audited less frequently than Schedule Cs. Out of 1.5 million C Corp returns filed in 2022, only 3,900 has been selected for audit, representing a 0.2% audit rate or a 1 out of 400 chance of being audited. So income aside, the structure you choose to do business under or make investments from may be the difference between your return being audited or not. One simple decision here can be the difference of having the IRS on your back or not. So this is important to keep in mind and to weigh carefully with your CPA. But there are many more reasons why your return could be selected by an audit here. And if you avoid these things, you may avoid an audit altogether. So let's walk through a few more items in this report that stands out, like math errors. When looking at the summary of all IRS activities in 2024, math errors and the automated underreporter stands out. The IRS sent over 1.7 million notices for math-related errors on tax returns and over 1 million notices for underreported income. And while these are just notices, they can quickly turn into an actual audit. Underreported income and math errors are a couple of the most common causes of IRS audits. The IRS uses many advanced systems to detect these errors on your tax returns, oftentimes automatically. They can compare your tax returns to similar ones like yours, or even ones that you have personally filed in the past to find inconsistency. They can also look at your business or your employer's tax filings to detect discrepancies in your income. They can even look at third-party payment providers that you use and even your merchant filings to detect some of your underreported income as well. Bottom line here is, if you want to decrease your chances of being audited, the first thing you will want to do is to make sure you report 100% of your income. The next thing you need to avoid is taking unusually high or suspicious deductions or credits compared to what is normal for taxpayers like you. For instance, one of the reasons why Schedule C forms are audited more frequently than others is because many taxpayers take unusually high deductions on this form. They may take more travel deductions, vehicle deductions, and other deductions that are unusually high for the amount of income that is being reported on their tax return. And these may be perfectly legitimate deductions, but remember that the IRS only allows you to deduct ordinary and necessary expenses on your tax return. If they find that you are deducting more expenses than what is ordinary or common for a return like yours, then it may raise their suspicion to audit your tax return. In this case, it is very important to follow the rules for any deduction that you claim and also to keep up with appropriate documentation to support it. Same thing applies to many other deductions and tax credits. If the IRS suspects that you are underreporting your income to qualify for certain tax credits, like the Earned Income Tax Credit, for example, which is highly audited already, then you may increase your audit risk substantially. And beyond anything, you want to make sure that you file your tax returns accurately. One simple error on your return can be the reason why your return is selected for an audit. That's why at our CPA firm, we have multiple sets of eyes on any return before we file it. We do not want our clients' returns to be flagged due to human error. And remember, tax return time is not the time to start being strategic about your tax positions. That's what tax planning is for. And if you need help with that, just go to mycpacoach.com to work with my CPA team today.